Hi and welcome to this podcast. If you've watched the podcast on general deductions actually incurred, you'll remember that we spoke about the Edgar Stores case. This podcast expands that case to add some hypothetical numbers to the scenario that will maybe help you to understand it a little bit better. So hopefully you'll remember from the Edgar Stores case that what the court decided was that in order for an amount to be actually incurred, you were entitled to estimate the amount, but you had to have an unconditional liability. And in the case of Edgar Stores had a rental contract for each of its stores. And in terms of that contract, it was obliged to pay a basic rental amount until such time as it exceeded a certain threshold turnover. And at that point, it ceased to be obliged to pay the basic rent and it became obliged to pay turnover rent based on a percentage of its turnover. And the court said until such time as you exceed that turnover threshold, you're not unconditionally liable for the turnover rent, you're only unconditionally liable for the basic rent. And so you may be recognizing a provision for the turnover rent so that you can show an equal amount of rent expense each month. But you're not unconditionally liable for that provision. You're only unconditionally liable for the basic amount. And that continues to apply until such point as you exceed the turnover threshold. So let's put some numbers to that and see how it looks. So I've created these numbers. They're not the real numbers from the Edgar Stores case, but I think they'll illustrate the point. Let's say that the financial year end is 31 December. And let's say that the contract for the lease runs from the 1st of July in the current year to the 30th of June in the next year. And the contract says that the lessee must pay the greater of 10,000 Rand a month, so that'll equate to 120,000 Rand for the year, or 5% of turnover. Now, if you work out how much turnover you need to have more rent than 120,000, you need 2.4 million. If you earn less than 2.4 million, you'll just pay that basic 10,000 a month, but once you exceed 2.4 million, the turnover rent will kick in. And let's say that the lessee expects their turnover to be 4.8 million, twice the threshold for turnover rent. That means they expect their rent to be 240,000 Rand over the 12 months. Now, from our accounting, we're pretty used to the idea that if we expect the rent to be 240,000, we should divide that by 12 and recognize 20,000 Rand a month. So we recognize an equal amount each month, and therefore if we're looking at our contract running from 1 July to 30 June, we'll recognize 120,000 in the first 6 months, which falls in tax year 1, and 120,000 in the second 6 months, which falls in tax year 2. And that's what Edgar Stores were doing in their accounting. And they said, well, if that's what we're doing for accounting, surely that's what we should claim as a Section 11A deduction in year 1 as well. However, income tax doesn't follow the accounting treatment. If the turnover threshold is 2.4 million, then assuming the expectations that we showed of 4.8 million, by the 31st of December, they will be exactly equal to the turnover threshold. Only on the 1st of January will they exceed the threshold. That means at the 31st of December, and for those 6 months, all they're unconditionally liable for is the 10,000 Rand a month. If the landlord had come in, say, November, and said, I want 20,000 Rand rent, Edgar Stores or our lessee would have been perfectly entitled to say, we don't owe you 20,000 Rand, we only owe you 10,000 Rand because we haven't yet exceeded the turnover threshold. And if you think about the accounting journal entries for this rent, that is true. When they recognized an expense of 20,000 Rand a month, they would have gone debit expense 20,000, credit bank 10,000, because that's all that they would have paid the lessor, and credit some sort of provision for the remaining 10,000. What we're saying is that credit to the provision, that portion is not deductible because at that date they're not yet unconditionally liable for that amount. a lot of things could happen before they exceed the turnover threshold. The store could close, the prediction could prove to be inaccurate and their sales could decrease, there may be a fire, they may go bankrupt. All sorts of things mean that they are not unconditionally liable until they exceed the turnover threshold. So what does that mean? Well, it means in year 1 they can only deduct the basic amount, 10,000 times 6 in our example, and in year 2 they must deduct the rest, the amount that they become liable for by the end of the contract. So there's no smoothing, there's no deducting of the provision for the extra rent. You only deduct what you're unconditionally liable for. So hopefully that's helped you to understand the Edgar Stores case a little bit better, and hopefully it's also given you a better idea about what it means to be actually incurred and why the tax treatment might differ from the accounting treatment. Thanks for watching.